Good morning. Happy Friday. Welcome to Sunrise Small Talk episode number 51. About 7:30 today. I thank you for your votes on the Bronco. The race is too close to call at this point. Orange leads by about 2 votes. We did have a vote for pink in there, so thank you, Rob, for the vote on pink. I know that was a joke, but actually check this out. Picture of a pink Bronco, which I had considered at one point because the value on the pink ones, because they're pretty rare, is very high, and honestly I think they're kind of cool. Of course it would then be Kelsey's Bronco. I would not drive it. It would just look cool. Today's episode we're going to talk about the inverse relationship between bonds and stocks, specifically when interest rates are going up. I had somebody ask how that relationship works recently and suggested I do this Sunrise video on it. So here we go. Let's dive in. There's a lot of things to factor, a lot of things that come into play when we're looking at this relationship, but I'm going to focus on 3: size, safety, and sectors. So number 1, size. The size of the global bond market is pretty significantly larger than the global stock market. If we think about who are the buyers, who are the sellers, that is the Federal Reserve banks of different countries, that is large institutional investors, that is governments, that is sovereign wealth funds. So they're buying massive amounts and selling massive amounts of bonds, and by the nature of how deep their pocketbooks are, we just have larger volume when it comes to buying and selling bonds. Thus it is a larger market cap. The numbers kind of vary depending on where you look, but some numbers I looked up this morning were about $114 billion global bond market versus 110, and it's not billion, it's trillion, $110 trillion stock market. The next thing, and the most important, is safety. As we know, bonds are typically safer than stocks. So if we think about that, when rates are going up, a bond becomes more attractive because it's an income-producing investment. It's going to pay a series of cash flows, and it's going to have a maturity date, so we know how long we have to hold it for. So when that interest rate goes up, when we know we're going to get more money, it becomes more attractive than a riskier stock market investment. Therefore, when new bonds are issued at those higher rates, if I'm an investor and I have cash on hand, I am going to find the bond more attractive than the stock. Thus, I'm going to be more inclined to sell stocks, to purchase bonds for the safety of my principal, and I'm getting a larger return, a larger interest rate than I was prior on the bonds that I owned previously. Another thing that comes into play, that's kind of part A of this. Part B is discounted cash flows. We call that DCF in the industry. That's how we value stocks. A discounted cash flow is basically looking at future cash flows and assigning a value to that today. That's what discounting means. So when we assign today's value to those projected future cash flows, what's a big piece of that equation? Well, you have taxes, you obviously have income, but one piece of that is how much are we paying in interest? So if bond interest went up, companies always typically are going to have, you can't say always typically, I said typically at the end there because companies like Apple don't believe in debt, but let's just say always. Companies always want to have debt because that is the norm. So if I know that my cost of debt is going to increase because interest rates increased, then that means my discounted cash flows are going to be lower because those future cash flows will go down because I am paying more in interest. So that's part B of it. And then part C, the third thing, is sectors. And if we look at different sectors, you will see that some sectors actually perform well in this type of environment when we have increasing interest rates. The two that come to mind are banks and insurance companies. we think about how banks and insurance companies make their money. Well, they have a ton of cash on hand. Insurance companies have to have a certain amount of cash on hand to cover their liabilities. So they're sitting on piles of cash, and it's typically going to be invested in treasuries, government securities. So again, interest rates go up. That's good for the insurance company because as they renew their bonds, their treasuries, they're going to get a higher interest rate. And banks. Banks lend out money. So that is good for banks when they are lending out money at a higher rate. So you can see financials, insurance companies that are kind of all in the same sector. You can see those sectors rise as interest rates go up. So there you have it, the relationship 101. Obviously, there's a lot more to it, but the relationship there between bond yields, bond rates increasing, and stock market stocks decreasing as rates are rising. Hope you enjoyed it. Have a great day. See you next time.